In this video we are going to talk about 10 ways on how to deal with market volatility. So before starting, please like this video and subscribe to this channel for our future updates. When the market is in turbulence, it can be difficult to maintain your composure. The implementation of tactics that prepare you both financially and mentally for market volatility is beneficial. These 10 tips can help you make smart decisions and understand how your actions will affect your ability to reach your financial goals in the long run. Number 10. Tell yourself that this too shall pass. Financial markets have typically been cyclical in nature. Even if you wish you had sold at what turned out to be a market top, or if you regret missing out on a good buying opportunity, there is a good chance you will get another chance at some point in the future to do so. Even if you're considering making adjustments, a volatile market may be an unwise moment to completely overhaul your investment strategy. Asset allocation that has been carefully considered remains the foundation of sound investment planning. Number 9. Be willing to learn from your mistakes. During bull markets, anyone may seem excellent, but it is the inevitable tough patches that breed the most successful investors. Even the most successful investors do not get it right 100% of the time. Sometimes the best option is to take a tax loss in order to learn from the experience and apply the lesson to future decisions. This is especially true if an earlier action now appears to be foolish. A financial specialist can assist you in preparing yourself and your portfolio to withstand and profit from the market's ups and downs, as well as identify and exploit opportunities. It's important to remember that working with a financial advisor does not guarantee that your investing outcomes will improve. Number 8. Stay on course by continuing to save. Even if the value of your possessions varies, making regular contributions to an account that is intended for a long-term purpose may help to mitigate the emotional impact of market swings in the short term. If your losses are partially offset by fresh savings, your bottom-line figure may not be as depressing as it first appears. If you're investing with dollar-cost averaging, which involves investing a certain amount on a regular basis regardless of market conditions, you may be able to get a better deal by purchasing while prices are low. Dollar-cost averaging, on the other hand, does neither guarantee a profit nor safeguard against a loss. Also, examine your capacity to maintain your purchases throughout market downturns. Systematic investing will fail if you stop making purchases when prices are falling. Finally, keep in mind that the return on your investments and the principal value of your assets may fluctuate with changes in market circumstances, and that when you sell your assets, your shares may be worth more or less than they were originally purchased for. Number 7. Use cash to help manage your mindset. Taking deep breaths to relax can be equated to the financial equivalent of taking cash. It can improve your ability to make deliberate decisions rather than impulsive ones, which is beneficial. In the case that you've developed a suitable asset allocation, you should have sufficient cash on hand so that you don't have to sell stocks to cover routine costs or, if you've employed leverage, to avoid a margin call. It is possible to adjust your perspective on market volatility by having an emergency cash reserve combined with a disciplined investing plan. Knowing that you're in a position to take advantage of a slump by snatching up deals may help you maintain your patience during a difficult time. Number 6. Consider playing defense. A lot of investors reassess their allocation to more conservative sectors, such as consumer staples or utilities, during periods of high volatility in the market, though like all stocks, those sectors involve risks too, and are not necessarily immune from overall market movements. Dividends can also serve to mitigate the impact of price fluctuations. Number 5. Remember your roadmap. A sound investment is built on the foundation of a diversified asset allocation that is consistent over time. Because the positive performance of some investments can be used to offset the negative performance of others, having a well-diversified portfolio is vitally crucial for financial success in today's world. Even with a well-allocated asset allocation, some components of a portfolio may experience difficulties at any moment in the future. Even in the best of circumstances, it can be difficult to predict when the market will turn. However, in exceptionally volatile markets, the ramifications of making a wrong judgment just before the market is about to move in an unexpected direction, either up or down, can be compounded by a factor of several orders of magnitude. Before making any big changes, make sure that your asset allocation is still the right one. Number 4. Look in the rearview mirror. Even if you're investing for the long term, it can be useful to take a step back and examine how far you've progressed. You may be tempted to lose sight of the profits you have made over the years if your portfolio is performing poorly this year. The stock market has historically moved in an upward direction over long periods of time, despite the fact that past performance cannot be relied upon for future results. When it comes to stock investing, remember that defining an investment strategy is only the first step in achieving success. The second requirement is the ability to follow through on that strategy. Although remaining out of the market may allow you to avoid losses, will you be able to discern when it is acceptable to return to the market? If you've used patience to build up a nest egg in the past, it may be advantageous to you now as well. Number 3. Know what you own and why you own it. As a general guideline, it's crucial to understand why you made your first investment in the first place. This will help you figure out whether or not your original arguments are still valid, no matter how the market is doing at the time. Another thing to keep in mind is that knowing how a stock fits into your overall portfolio can help you decide whether a lower price is a good time to buy the stock. And if you don't understand why a certain security is in your portfolio, find out why it is in your portfolio by asking the right questions. When the market is down, this might be quite essential, especially if you're considering swapping out your existing investment for a new one. Number 2. Remember that everything is relative. The majority of the variation in the returns of different portfolios may be traced to the asset allocations of those portfolios on average, rather than to their individual asset allocations. When you have a well-diversified portfolio that includes a range of asset classes, having the opportunity to compare your whole portfolio performance to relevant benchmarks may be advantageous to your decision-making. In the event that you discover that your assets are performing in accordance with those benchmarks, you may find that this realization allows you to feel more secure in your entire approach to investing. It goes without saying that even a well-diversified portfolio cannot guarantee that you will not experience losses at some point in the future. However, due to the nature of diversification, just because the S&P wink with tongue sticking out 500 is down 10% or 20% does not always imply that your entire portfolio is down the same percentage. Number 1. Have a game plan. Making judgments based on preset criteria that take into account the possibility of tumultuous times might help you avoid allowing emotion to dictate your actions or inactions. In the case of your portfolio, you might use a core and satellite strategy, combining the usage of buy and hold rules for the majority of your holdings with tactical trading based on a shorter-term market view. You can also use diversity to try to balance the risks associated with individual holdings with the risks associated with other holdings. Despite the fact that diversification does not guarantee a profit or protect against a loss, it can assist you in understanding and balancing your risks in advance. Furthermore, if you're an active investor, maintaining trading discipline can assist you in sticking to a long-term plan. Consider a predetermined profit-taking strategy in which you sell a security or index when it rises by a certain percentage and buy it when it falls by a certain percentage. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.